kind of at the crux of the problem from a market standpoint. If you're going to go in a direction, you really would like monetary and fiscal policy, to the point about credibility and uncertainty. If the market sees it going in a direction, may not like the direction, but it kind of understands the direction. When they're across purposes, that creates a lot of uncertainty, and I think that's part of what's underlying
which is astounding in the UK, right? Where in principle you ought to be able to get those things a bit better in lockstep. In Europe, where we're dealing with the disconnect between a centralized monetary policy and nationalized fiscal policy creates even more risk. And I think, the question was, what should we learn about some of the issues in the UK over the last couple of weeks? I do hope that it's a signal to other European economies with similar challenges around sovereign indebtedness that we do need to get fiscal and monetary policy to line up, and it needs to be clearly signaled, and it needs to be well structured and well thought through.
And just one sentence of what John said about the inconsistencies between fiscal and monetary. You even heard Andrew Bailey here talk about the inconsistency of the central bank policy at the one side running off assets from the balance sheet, at the other side going into a market to intervene when there are tensions in the UK gilt market. So it's these inconsistencies that rock the market, because you got to become consistent again. So you've got to place a bet on which of the two options they're going to forgo. And what we heard from the governor, he actually is on a path where he wants to continue to tighten monetary policy and run the balance sheet off. And that was a short-lived episode. But generalizing that, there will always be short-lived episodes like the treasury market problems, where the central bank, for financial stability concerns, is forced to intervene in the market. And that might be at the point where financial stability is not consistent with our overall monetary policy strategy. So there are these trade-offs, and they have to react to the situation.
Well, I mean, since you brought up Andrew Bailey, let me ask you, did he fail to read the room correctly when he sat here a day or so ago and gave the market an ultimatum and said, we'll be done at the end of this week, no more support, effectively? Was that a mistake?
Well, I wasn't in the room, so and it's hard to read, and it's hard to read from up here because you have these bright stage. No, but look, I think, I don't want to comment on single decisions or communications by central banks, but what you do see in the central banking world is they're facing a lot more trade-offs that determine now what they do. And so a speech like the one that Geoff Powell gave at Jackson Hole laid his strategy out very clearly. And I think that's what the market appreciated. He gave a very clear guidance. Here we go. The job's not done till we see inflation disappear in the rearview mirror. That's a very clear, that's what the market needs. You can then optimize around that, but there's no doubt that Jay Powell does not want to enter the history books as an Arthur Burns, but he wants to be seen as a central banker who's a tough central banker who had inflation appear, it got out of control, and we get it back under control. And that was the message to the market. It's the top priority of the Fed. Take the trade-off that the Fed have between employment. He's basically said, for now, there's no trade-off. Inflation is the prime focus. We're going to get the job done. And that was very healthy. And I think central banks should give pretty clear guidance. The ECB is still, in my view, not as clearly decided and not as clearly in communication of the direction of travel over the next 12 to 16 months as the Fed has since the Jackson Hole conference.
I think, to Axel's point, one of the big challenges to me that the European central banks have, maybe a little bit more so than the Fed, is you're tightening into a very clear recession.
Yeah.
As opposed to in the U.S. where it's not clear. Many of us are predicting that, this is the best predicted recession of all time. So everybody predicts a recession, but we're not actually in a recession in the U.S. And so you have 3.5% or so unemployment. So they do actually have a lot of room in their mandate. Whereas in Europe, it's a much more complicated situation. Not to take them completely off the hook, but it's a much more complicated situation.
No, absolutely.
And I think you're tightening into an economic contraction. And Axel knows this better than I would as a former central banker. That has to be you have to be more contemplative, I would think, about how far you go in that environment.
And doing that in the midst of an very unpredictable
Absolutely.
energy crisis, which is, of course, exacerbating the inflationary pressure. So it's an incredibly complex calculus for the European Central Bank.